biggest players in the market are the banks and the hedge funds. So if you look up, who are the biggest market participants, move this over, who are the biggest market participants, you'll see that Chase Bank has a 10% share. All these other banks, if you were to add these up, and these are just the banks, these are not including just hedge funds as well. But the top 10 Forex traders in the world are all banks. Now, you got to ask yourself, would a bank trade the exact same way a retail trader with a few $100s in their account or a few $1,000s in their account trade? And the answer to that is no. The reason being is because if they were to place, and I wish I had my screenshots of the type of lot sizes that they place, but to put it in perspective, a lot of people they want to trade a standard lot. When they really start doing trading, the goal is to trade a standard lot. A standard lot is $10 per pip, roughly. It's $10 per pip gained. That's the standard lot. That's what a lot of retail traders want to be able to trade on a consistent basis. It's a standard lot. Now, I've seen trades open with banks that has 270K standard lots. One trade, 270K standard lots. I believe that is $270,000 per pip. Actually, no, 2.7 million, my bad. I add one. 2.7 million lot per pip. So if they're trading account and lot sizes of things like, 270,000 or 45,000 standards, they have to be able to move differently and be able to trade in a way to where it'll be profitable for them and not break the market. So there's certain things that they do. There's certain things that they do that would be a small one. There we go. To make sure that they have the right entries into the market. And when you learn what I'm about to show you, you'll be able to actually spot these trades out. And when you're able to spot those trades, you can plan for them for your trades. Because if you're trading with the money, that means the market, when you're trading with the big banks, with the hedge funds, the trades that you place are going to react in a lot faster ways versus the trades that other people place. Like, me and you are not going to move the market, but when they make a trade, the market moves. So there's going to be four key terms that you want to know of. You want to know of liquidity grab. A lot of retail traders call it the FU candle, and you'll know why. Imbalance and mitigation. Those are the four pillars of institutional trading. I'm going to show you kind of what that looks like. So everyone has, their trading knowledge. A lot of people have like the baby pips and the basic, websites for learning trading before, any platforms came out. And what you would see on those platforms are certain trading like formations. So for example, yeah, use this one. For example, when you see this trading formation, I'll just leave that there. That's known as, a double top. This is one of the more popular trading formations. Now, move this over here. Let's break this down psychologically, because if you can understand this psychologically, you can understand the whole big picture move of the banks. So what's happening before a double top is you're getting a up move before the double top. So you got an uptrend. Double top is, forming, they're having a last rally. There's some resistance. They try again, it corrects down. Maybe there's some support resistance here. Or maybe there's some support, something along these lines of a support resistance. So people are buying again, thinking that the market is going to go up, but it doesn't. And the markets eventually correct back down. Now, that what I just showed you is what's commonly taught in the markets. But what actually happens is, if you think about where would actual retail traders trade, the number one question you want to ask yourself when trading institutional is, where is the money? And the money resides in stop losses, limit orders, and stop orders. So, you're buying your sell stops. Where would the majority of these three things be located if a retail trader was looking at the chart? Because if you think about it, the banks fund the brokers. And one of the conditions of a bank funding a broker, like a Forex broker, is that they must give the banks an order book. And an order book is basically the list of orders, just like if you're looking at the stock market or exchange market on crypto, the list of orders that is placed at certain levels. So, like, for example, they would know where your stop losses are. They would know where your limit orders are. They would know where your stop orders are. They would know where those things are and be able to place trades with that liquidity in mind. Because for a bank to buy, because trading is still trading. So for a buy to happen, there must be an equal value of sales. And, vice versa, for a sale to happen, there must be enough liquidity in the markets for that sale to happen at that price. So if the banks have the most amount of liquidity, if they try to place a larger trade for them, they may not be able to execute on that trade at that price. So move that up here. So when it comes to this is commonly taught, and the banks know that this is commonly taught. Doesn't mean it doesn't work. It just, they know that they can use it for their benefit. So the double top, people are buying, you got buys, all the way. Let me just make that green. Got buying all the way up here. There may not be enough buys once this starts slowing down, because when the market starts to reverse, those candles start getting smaller and they start kind of leaking up. So even though people are buying, it may not be enough buys for them to make a sale. So what they do, they entice more people to buy. How do they do that? Well, what happens is they take the sale. So this first top is like a test sale for the banks. So they sell there. Now retail traders thinking, oh, it's break and retest. Let's buy again. So there's more buying interest. There's more buying interest from that sale that the banks made. And now people start buying again. And what might happen to ensure that people start buying again, the banks may take a small buy here to start that domino effect. So now you got this leg of this X to Y leg of a double top. So now, people are buying. They're like, oh, people are about to, there's a couple types of traders. You got the break and retest traders, and then you got the breakout traders. So what's happening is above this double top, above that double top, there are buy stop orders for breakout traders. There are stop losses. There's stop losses for sales. So sales stop losses. So basically somebody is selling the market and they're trying to, catch the reversal. And they may be trying to catch the reversal early. But up here, so up here, people that have sold here, they most likely have their stop losses here, like people that are selling in this area, they have their stop losses above that top. People that want to wait for a breakout has that order, that buy stop order above the double top to try to catch the momentum up. And then you also have retail traders. You have retail traders adding to their positions on the way up. So above this double top is where a lot of liquidity is located. So what do the banks do? So a lot of people start trying to sell here as well. Sell at this double top because that's what a lot of people do. Get an equal double top. People want to also sell here. So it's also sell limit orders. But most people are going to have those sell limit orders somewhere in here. Their sell stops above it. So all in all, the liquidity in the market in this particular time is located right there. And the banks know it. That's where the money is located. So what do? They think that you're about to sell here. You got your stop loss here. So what they do is they have an extra buy right there. So they buy here. So let me kind of illustrate that. So they buy there. And then what they do right after it is then they place their sell. When they meet that liquidity point where they can make their move, they place it. So then the sale happens. So, and you'll see moves like this in the market where there's maybe like a high point or a low point, and then there's a small push above or below that low point, then a big shift in the market. When you see that, that is a bank's trading order. So now, and they're getting more liquidity as they're going down because people are going to think, oh, it's just giving me another retest here. Like in this area, it's another retest. So people will buy here, adding to the liquidity of them selling. So that way, when this breakout trade happens, because people are going to have a breakout trade sell below this double top, that'll work. But by that time, these people got stopped out, those people got stopped out. The people that were trying to do a small break and retest here, where the market went above double top and came down, they were thinking that was another retest. They bought there. So all of these types of traders lost that trade, while the banks are cashing in on the liquidity. So now that that this is a similar move, so you'll see moves like that, and what you'll notice is that, kind of clone this. What you'll notice is, it changed it up. There we go. That you'll see smaller candles. That can let me move it. It's not gonna let me move it. And you can see smaller candles leading up to that, and then a big candle there. So now, how does this show up on a chart? Let me go to. A lot of people probably are asking, how did I find Euro JPY last week? Why was that so accurate? Oh, I gave it away. So last week, March, it was actually this move here. So what was last week? February 25th. That's when we had caught this move coming down, and now people were in drawdown from selling this move, and then we were able to catch it. And I was given a heads up that this right here was going to be that reversal point. How did I know that? I'm gonna show you the secret to why I was able to find that. So if I go further out, it was here. So if I go further out, we look on the weekly chart. Let's kind of replay this. You see something similar happening on that chart. So let's zoom in just to this part. You see something similar happening. So I just went over that diagram. You see, this is the weekly chart. You see a double top, a potential double top at this point. So let me play one more candle so you can see it better. Too slow. Okay. All right, there we go. So you see a potential double top. So you have this level here. You have that level here as a potential level where people will notice their double tops. So people are going to start, either trying to sell here, or they would have their buy stop order here to continue upwards. Also in that area would be a sell stop loss in this area. I know I'm putting a lot of information, but this is why this is going to be recorded, because you may have to watch this a couple times, but when you get in, you have that light bulb effect, like it's game over. But they would have their sell stop loss up here. And then if the market were to break and retest, people would also buy that break and retest. So That would be, a break and retest, buy. And what is a sell stop loss? Like to end a selling position, you got to buy your position back, thus for taking the loss. So a sell stop loss is also a buy. So you got three major types of traders, three large groups of traders having buy orders in this area. So what does the banks do? They press up into that area and then they start making their position down. Just like that. Now, here's the thing. This candle here, remember I was talking about that last up closing candle. This candle here was called their FU candle. So the liquidity grab or the FU candle, because basically this candle here is messing up all these people's trade ideas. All these people trade ideas and stopping them out the market. But here's the thing, they can't close this position. So what the bank has to do, and since they have so much liquidity, they themselves are taking drawdown on the position, on the bigger position that they did here. So they're taking drawdown. So where did they open this buy position? Because the banks want to get back the money that they invested into this trade to create this profit. So where would that money start? Would it start at the close of a candle, or would it start where it opened? It would be where it opened, because for the candle to go up, a trade must be opened large enough to move the price in a certain direction. So what do? You measure out the opening. So you got the opening there. And that opening of the candle in the future will be a potential point, after the move has been made, a potential point where the markets turn around at. So let me undo this. So we got those two red lines. So daily. Let's zoom out. This was last week. So you see from how long ago was that move? This is how long a bank can stay in drawdown. And this is why the software trades in the way it trades, because it trades like a bank as well. This bank, whoever did that, was in drawdown. This is September 17th, this week that they made this move, September 17th, 2018. They are in drawdown from September 17th to February 2021. And if you go back to the daily chart, they literally, from where this move happened, was about within 15 pips from the opening of that candle in 2018. That's why this move happened. They had called out on some of their positions. That drawdown they're in, they closed out of some of their positions, and that's why this big, massive move, happened so fast. That's why it was crashing down, because they were releasing their positions from back then. Now you have something similar. So this was they did the same thing here. Last up candle before the close, like before that crashed down. That was that last candle. This is when we were all, panicking about the drawdown. This last candle, and then everybody got happy real quick once this happened. So similar thing happened the other day. Because this will happen on bigger time frames. It'll happen on smaller time frames. I can show you where this happens on a 5-minute time frame for people who like to scout. But let's zoom in. Let's go to the hour. So same thing. You're pushing the markets up, pushing the markets up. Last major push. See this candle here? Last major push was here. So let me highlight it. This little move here. That little move here. Where did that move start? At the opening. You would have had a perfect trade entry. No drawdown. Just off of this. It happens over and over again. I can show you again. This move here. This, you probably see it on the 15-minute. This was the other day. I think it was Friday. Last up candle here. Last push before. This is how Gearbox looks at his positions too. So they'll let all this not be drawdown and then find their position up here. But this trade here, you may, if you put an order there, this trade here was 3 pips in drawdown, 70 pips in profit in about 5.5 hours. Actually, let me be more accurate. Start here. In 4.5 hours. Yeah. So this is happening over and over and over again. You could probably see it more if I went to the 5-minute and showed it to you. So see, you got the last little push, then that big candle that came back, touched into that. So the banks closed that. See the drawdown here. They had a buy order here, so they're taking a small drawdown while on the other side they have a sale that's getting them profit. So they're making more profit than the drawdown that they're taking. Sound familiar? Making more profit. They close out of their profit here. And then the market starts naturally going back up because people are starting to buy again. And then they have their order up here. It gets to that level and they close out of that order, which means they sold because they bought here. That means this is a sell. And that's why that happened fast. So now we get to, I can show you a trade that I took this morning before I get to you, Jay. So similar thing happened here. This was a little bit more trickier. And it's still, here we go. And it was a small trade, 5-minute. So here we go here on the 5-minute. Selling, double top potential, double bottom potential, but no, they push into that liquidity, shoot it up, and then the market comes back down to that opening area, and then shoots up again. So if you would have had a small little trade, you don't have to have crazy big trades with this strategy. It's about, risk management. So you had a position here. You have your stop loss there. Say this stop loss, you're risking 2% of your account. 2%. So you have a 2% risk here. And you're looking for a 3-to-1, take profit, or a 2-to-1 take profit. I like to go for 3-to-1. 3-to-1 take profit. You have give it a little bit more. A 12 pip stop loss. 3-to-1 is be 36 pips. So 2% stop, 2% risk. You may, if you did a 3-to-1 reward on 2% risk, you would have made 6%. That's my thing. 6% on this trade. Past profits don't guarantee future results, but this is trading. 6% on your account in a matter of an hour and 20 minutes. This is what the banks are doing on large levels with the money that's in your bank account. That's why when you buy something, it takes 2 days to process because they're trading. Or you get a refund, it takes 2 to 3 days to process because they traded. You get a check, deposit a check, it takes a week because they traded. All that stuff can be instant, but that's a whole nother topic. So for those who waited, they're about to see UJ now. So we take that same mindset that we just went over and we look into UJ. Oh, potential double top. So you have this order here. Potential double top. If that would have went through, but no, they pushed past that level, scare people. They pushed past it about 80 pips, closed people out of trades, and they moved down. So what candle are we focusing on? We're focusing on this candle. Where is the opening? Let me zoom in. Where is the opening of that candle? 109.6, so 109.06. And with this trading method too, because your risk to reward is so high on this trading method, you don't have to be accurate with it either. You could be 50% correct, 40% correct, and still be profitable. Like say if you want to take this trading method on as a manual trading strategy. Because if you're 3-to-1 all the time, all you need to be profitable is 40%. Something to keep in mind. That's the percentage of accuracy you would need is 40%. But back to UJ. So that is the area of interest. So when I see that, this is my point of interest when I trade. So if we zoom over to where we're at now, we are 20 to 30 pips away from that area of interest. And because this is there, the banks have an interest, have a investment interest to get back to this level, so they don't take a loss because they're greedy. They don't take a loss on this buy. Because like say if they, I don't know if you ever seen where you have those flash crashes in Forex and all that, where like it just spikes up 200 or 300 pips in 1 hour or so. What happens is a bank places a trade wrong and they mess up the market. So they have to be strategic in how they trade. So that's why they hold on to this buy. But now they want to break out of that buy. And that breakout of that closeout, that break-even closeout is going to happen pretty soon. So for those who are holding UJ, so look into this area. I'll make it a zone. I don't want to do like a whole, just point. A lot of times what I do is I measure out 50% of that candle. Which one is it? Big candle. There we go. Oh, that. Why is that not changing? Okay, that's just not working. All right, let me just redo it. Why won't this thing change over? Template. Okay, it refuses. All right, so manually. That. All right, there we go. So I like to measure out 50% of that candle. So what I do is I have from the open to 50%. And there is my area of interest in UJ. So let me just completely mark this out so everybody can get this in one view. Zoom out. Do it one day. So hopefully, if anybody, everybody that saw this, hopefully your mind's not too blown. But if you grasp this idea of trading could be very fun for you. I would definitely recommend, if this is your first time learning trading, I guess I gave you the highest form of trading for your first lesson. But now I would recommend going back to the basics and learning that so you can truly understand what I just showed you. But let me mark this up. Zoom out a little bit more. Close that out. So thanks for being on. I'm going to mark this up. I will put it in our group chat. And, if you have any questions, I'll definitely be answering questions in the group chat. But thanks for being on. This recording is going to be saved, and you'll be able to see this pretty soon. Hopefully, I was able to give y'all value. Y'all have a great one.